We're constantly hearing about a company's exciting new ventures or, potential financial troubles, often focusing on their assets and debts.
Yeah, the headlines usually grab onto those numbers.
But there's this whole crucial area of their financial health that's sometimes overlooked, the equity section.
Uh-huh. Accountants often refer to it as the pure asset section, and today, well, that's exactly where we're diving in.
Perfect. Let's set aside the daily news about profits and losses for a moment.
Right. In this deep dive, specifically tailored for you based on learning materials from the Japan Accounting Education and Training Institute, our mission is really to unravel this pure asset section.
So we're talking equity, comprehensive income, what else?
And those often slightly confusing retrospective adjustments.
Yep.
Think of this as your shortcut, your way to get the key practical takeaways from Japanese accounting standards, or JGAAP. That's Japanese Generally Accepted Accounting Principles, just for clarity.
Precisely. We've sifted through these JGAAP educational materials to bring you the essential insights, without getting totally lost in every single detail.
It's about hitting the main points you need to know.
Okay, let's unpack this pure assets section. At its core, it comes down to a pretty fundamental equation, right?
It really does. Equity, assets, liabilities. Simple as that on the surface.
It represents the owner's stake in the company's assets after all the debts are paid off.
Yeah, basically what the owners have put in, what the companies earn and kept over time.
Plus a few other, let's say, miscellaneous items that don't quite fit neatly into those buckets.
Exactly. And what's fascinating here, especially under JGAAP, is that while the rules for assets like property, plant, equipment, or liabilities like loans are incredibly detailed,
Not very specific.
the specific items within equity, surprisingly, don't have that same level of detailed accounting standard guidance.
Really, so it's more about showing the pieces clearly.
Yeah, the main emphasis seems to be on disclosure, making sure companies clearly show all the different parts that make up their equity.
That's interesting. Does that lack of specific granular guidance ever lead to maybe companies interpreting things differently, making comparisons harder for investors?
That's a great question. It potentially could, although the disclosure requirements aim to provide clarity. But let's look at the structure. When you look at the equity section on a balance sheet, you usually see it divided into two main areas.
Okay, what's the first?
First, there's shareholders' equity, and that itself contains several important subcategories.
Right, like capital stock.
Exactly, capital stock. This is established when a company is formed or issues new shares. A key point here is that it must be more than half of the total money initially invested.
So more than 50% of the paid-in capital goes here.
Correct. And its amount is officially registered, so it's not something that changes, easily day to day.
Okay. What else is under shareholders' equity?
Well, sometimes you'll see a temporary account called subscription receivables for new shares.
Ah, like an IOU.
Pretty much. It appears between the time investors agree to buy new shares and when they actually hand over the cash. Once the company gets the money, this account just vanishes.
Makes sense. Then we have capital surplus.
Yes, capital surplus. This is essentially the extra money generated from transactions involving the company's ownership, separate from the core business operations.
And that's split too, isn't it?
It is. It's further divided into capital reserve. That's the portion of the initial investment that wasn't designated as capital stock right away.
The bit less than 50%, potentially?
Yeah, exactly. And then there's other capital surplus. Now, other capital surplus is a bit of a catch-all.
Okay, what kind of things end up here?
It includes things like profits from selling treasury stock, we'll get to that, and amounts left over when capital stock or capital reserve are formally reduced.
Right.
And here's where it gets really interesting, as you hinted at earlier.
Yeah.
This other capital surplus can also be used to fund the legal reserve.
When a company pays dividends out of retained earnings.
Precisely. If that legal reserve isn't yet up to 25% of the capital stock, they can tap into other capital surplus to meet the requirement.
Wow, that's a clever way to ensure financial prudence while still allowing for those dividend payouts.
It provides some flexibility, and that's a crucial link to the next major component under shareholders' equity, retained earnings.
Okay, the accumulated profits.
Exactly. This represents the profits a company has built up over all the years it's been in business, less any dividends paid out. It's also divided.
Into what?
First, there's the retained earnings reserve, also known as the legal reserve. As we just discussed, this is built up as legally required when dividends are paid.
10% rule.
Right, 10% of the dividend amount gets tucked away here until the total reserve hits that 25% of capital stock threshold. Think of it like a company putting aside a little bit of money each time they share profits, just in case, or because the law requires it.
A mandatory savings account, sort of.
You could put it that way. And then we have other retained earnings. This is simply the profits that haven't been distributed to shareholders yet, the pool available for future dividends or reinvestment.
Got it. And what if a company has losses?
Interestingly, even if a company has experienced losses over time, resulting in a negative balance in retained earnings overall, it's still shown under this retained earnings section. Doesn't get, hidden somewhere else.
Transparency, I suppose. Okay, one more item under shareholders' equity.
A very important one, treasury stock.
The company's own shares that it bought back?
Exactly. These are shares the company has repurchased from the market and is holding itself. There are legal rules and requirements around why and how a company can buy back, hold, and then maybe resell its own stock.
And why would they do that? Seems counterintuitive.
Well, holding treasury stock can actually have some interesting effects. It can potentially boost earnings per share or EPS because there are fewer shares outstanding.
Ah, dividing the same profit by fewer shares.
Right. It can also reduce the total amount of cash needed to pay dividends. Again, fewer shares to pay out to. And it gives the company flexibility for things like employee stock options or maybe using shares in mergers and acquisitions.
Okay, that makes sense. So that covers shareholders' equity. What's the other main area in the pure assets section?
The second main part is labeled items other than shareholders' equity. This is where we find things that don't quite fit the traditional definitions of assets, liabilities, or that direct owner's stake we just discussed.
Like what, for example?
Think about valuation and translation adjustments. This category includes things like unrealized gains or losses on certain investments, specifically available for sale securities.
So changes in value that haven't been locked in by a sale yet.
Exactly. Also, deferred gains or losses from hedging activities, and crucially for consolidated statements, accumulated other comprehensive income.
Okay, what falls under that?
That includes adjustments from converting a foreign subsidiary's financials into the parent company's currency, usually yen for JGAAP, and also changes in the reported amounts of defined benefit pension plans. These can fluctuate quite a bit.
Right, those pension calculations can be complex. What else is in this other items bucket?
We also have stock acquisition rights. These are created when a company promises to issue shares later, often in exchange for services received maybe as compensation for directors, but before the actual shares are handed over.
So it's like a placeholder in equity?
Pretty much. It's a temporary item reflecting that obligation to issue shares. Our materials cover them, but perhaps a bit more concisely as they are, a bit more niche.
Got it. And related to that, stock options.
Yes, then there are stock options. These give individuals the right, but not the obligation, to purchase company shares at a specific price within a set time frame.
And they serve different purposes, right?
They do. Often used as incentives to motivate employees and executives. They can also be a way to raise capital, or sometimes even used as a defense against a hostile takeover.
How are they issued? Is it just the board deciding?
It depends. Sometimes the board of directors can approve them, but other times, especially if the options are offered at a very favorable price, well below market value, a shareholder vote might be required.
And the accounting, how do they hit the books?
Okay, so when stock options are initially granted, their fair value is recorded at an increase in equity, usually credited to a stock options account.
Right.
When they're eventually exercised by the holder, that initial value gets moved into capital stock and potentially capital reserve, reflecting the new shares issued.
And if they just expire unused?
If they expire without being used, the company usually recognizes a gain, reversing the initial equity entry. This gain is often classified as a special profit on the income statement.
Okay. Anything else in this other items section?
Just one more key item, primarily for consolidated financial statements, non-controlling interests.
Ah, the part of a subsidiary the parent company doesn't own.
Precisely. It represents the equity attributable to the outside owners of a subsidiary.
And I imagine things can get even more complex.
Oh, definitely. We could get into the weeds on potential differences in, say, capital surplus amounts between the consolidated statements and the individual parent company statements. These can pop up due to complex business reorganizations or changes in how much of a subsidiary the parent owns over time. But maybe that's for another day.
Fair enough. Okay, so we've got a solid map of the different parts of this pure assets section. Now, what happens when a company decides to, say, reduce some of these components, like getting rid of treasury stock or cutting back on those reserves? Why is understanding the reductions important?
That's the next logical step. Knowing how these equity accounts decrease is just as important as knowing how they're built up. Let's start with reducing capital stock. The accounting is relatively straightforward.
Okay.
When capital stock is decreased, the amount it's reduced by is generally credited to other capital surplus.
So it moves into that surplus bucket.
Correct. Similarly, when the capital reserve is reduced, that amount also goes into other capital surplus.
So both reductions feed into other capital surplus.
Generally, yes. And it's really important to remember that capital surplus and retained earnings are usually kept separate. You can't typically just shuffle amounts between them freely.
But you mentioned an exception earlier.
Ah, yes, the key exception. If retained earnings has a negative balance, meaning accumulated losses, then other capital surpluses can be used to cover that deficit. It acts as a sort of financial buffer in tough times.
Okay, that makes sense. And what about reducing that retained earnings reserve, the legal reserve?
When the retained earnings reserve is reduced, which might happen under certain circumstances allowed by law, the amount is credited to other retained earnings.
So it flows back into the general pool of undistributed profits?
Exactly. It increases the amount available for potential future distribution or reinvestment.
Now, treasury stock seemed like it had a few more wrinkles when it comes to reductions or getting rid of it.
You're right, it does. Let's break it down. First, when a company buys back its own shares acquiring treasury stock, the cost of those shares is immediately deducted from total shareholders' equity.
So it reduces equity right away. How is it shown?
It appears as a single negative line item, usually presented at the very end of the shareholders' equity section.
Okay. Then what happens when they sell those shares back into the market? Disposal.
Right. If the selling price is higher than what the company originally paid for those shares, the difference is credited to other capital surplus.
So gains go to surplus, not income.
Correct. But if the selling price is lower, resulting in a loss, that loss reduces other capital surplus.
Okay, debited to other capital surplus.
Yes, and here's a key point. If that loss is so large that it makes other capital surplus negative, you bring the other capital surplus balance back up to zero, and any remaining negative amount then reduces other retained earnings.
Ah, so retained earnings can be hit if the loss on treasury stock sale is big enough to wipe out other capital surpluses.
Exactly. It acts as a second buffer after other capital surplus.
And what if the company decides to just cancel those treasury shares entirely, not sell them again? Retirement.
That's called the retirement of treasury stock.
Mm-hmm.
When that happens, the original cost, the book value of the retired shares, is debited, which means it reduces other capital surpluses.
Similar treatment to a loss on disposal, then.
Very similar logic. If retiring the shares creates a negative balance in other capital surpluses, again, you zero out that balance, and the remaining negative amount reduces other retained earnings.
Got it. How do they track the cost if they bought shares back at different prices over time?
Good question. Companies need a consistent method. They typically use something like the moving average method to determine the cost of the specific treasury shares being sold or retired.
Makes sense. And any costs involved in these transactions? Broker fees, etc.
Any expenses directly related to buying, selling, or retiring treasury stock, things like brokerage fees, are generally recognized as non-operating expenses on the income statement in the period they occur.
Okay, this level of detail really helps connect the dots on the balance sheet and how equity changes. And speaking of connection, let's shift gears slightly. Investors heavily rely on per-share information. Why is this data so critical for them?
Oh, absolutely critical. Per-share information is incredibly important because it standardizes financial data. It allows you, as an investor, to make meaningful comparisons between companies, even if they're vastly different sizes.
So it levels the playing field for comparison.
Exactly. It provides a basis for easier valuation and performance assessment on an individual ownership level.
Yeah.
What does one share represent?
And what specific per-share info are companies required to disclose under JGAAP?
According to the relevant standards, ASBJ Statement Number 2 and its application guidance, the key per-share figures that companies must disclose are net assets per share.
Sometimes called book value per share?
Yes, essentially. Then net income or loss per share, which everyone just calls EPS.
Or earnings per share.
And, importantly, diluted net income per share or diluted EPS.
Okay, let's delve into diluted EPS. It can sound a bit complicated, especially when companies have things like options or convertible bonds. Our sources even provide a scenario to illustrate this.
Yes, scenario 1 in the application guidance is actually really helpful. Imagine a company that has outstanding stock options, maybe some convertible bonds debt that can be exchanged for shares, and perhaps preferred stock that can also be converted into common shares.
Lots of potential new shares floating around.
Exactly. Diluted EPS attempts to show the impact on earnings per share if all of these potentially dilutive securities were exercised or converted. It's a what-if scenario.
How does that calculation work? Is it just adding all potential shares?
Not quite. The process involves figuring out which of these potential new shares would actually have a dilutive effect, meaning they would decrease the reported EPS if converted. Some might actually increase it, which we ignore for this calculation.
Okay, so only the ones that make EPS go down.
Right. And then you need to consider them in a specific order, usually starting with the security that has the most dilutive effect per share, and then adding the next most dilutive, and so on.
The step-by-step approach.
Correct. And it's also crucial that companies disclose any potential shares that were not included in the diluted EPS calculation because they would have been anti-dilutive, meaning they would have increased EPS. You have to mention those too.
Transparency again. So investors use these per-share figures for more than just looking at the single number, right? They feed into other really important financial ratios.
Absolutely. Per share information is fundamental for several key ratios used constantly in investment analysis.
Like the PE ratio.
Exactly. The price to earnings ratio, PE, uses earnings per share. It basically tells you how much investors are willing to pay for each yen or dollar of a company's current earnings.
And PB.
The price to book ratio, PB, uses net assets per share or book value. It compares the company's market value to the accounting value of its equity.
And ROE, return on equity.
Right. ROE measures how effectively a company is using the money invested by its shareholders to generate profit. It uses both net income and equity. Interestingly, these ratios are actually interconnected.
Oh, so?
Well, mathematically, ROE is equal to the PB ratio multiplied by the inverse of the PE ratio. So PB times 1 divided by PE.
Huh. Interesting connection. Our materials even point to real-world examples where these ratios pop up all the time.
Oh, constantly. You see these ratios mentioned all the time in financial news and analysis. For instance, there have been reports about the Tokyo Stock Exchange, the TSE, paying close attention to companies with a PD ratio below 1.
Suggesting they might be undervalued.
That's the implication, that their market value is less than their accounting book value. You also often hear discussions about how the overall performance of the Nikkei average, a key Japanese stock index, is related to the average earnings per share of the companies in it.
So these ratios really drive investment decisions and market analysis.
They definitely play a significant role in investment strategy. Conversations about corporate governance, how well a company is managed, and broader market trends.
It sounds like even the financial regulators are keeping a close eye on how companies calculate these figures.
Indeed. Reviews by Japan's Financial Services Agency, the FSA, have highlighted some common pitfalls in calculating diluted EPS.
Such as?
Things like ensuring companies properly account for warrants or options that were exercised or expired during the reporting period, and making sure they're using appropriate average market prices in the calculations, not just year-end prices or outdated figures. Accuracy matters.
And what about big events like stock splits or reverse splits? How do those get factored in?
Good point. If a stock split happens where each share gets divided into multiple shares, or a reverse stock split where shares are combined during the reporting period, companies have to disclose it.
And adjust the numbers.
Yes. They have to state that the per-share figures, like net assets per share and EPS, for all periods presented in the financial statements have been adjusted retroactively, as if the split had happened at the beginning.
So comparisons remain valid.
Exactly. And the same disclosure requirement applies if the split happens after the fiscal year ends, but before the financial statements are officially issued. Our materials even noted a past CPA exam question focused on stock options disclosures, just underscoring how important these details are for professionals.
Okay, we've covered a lot on equity components and per-share metrics. Let's turn now to comprehensive income. What exactly does this term encompass? It sounds comprehensive.
It aims to be. Comprehensive income offers a broader view of a company's financial performance than just the traditional net income figure.
How so?
It captures the total change in a company's net assets, its equity, during a specific period, resulting from all transactions and events except those related to investments by owners, like issuing stock, or distributions to owners, like paying dividends.
So it's basically net income plus some other stuff.
That's a good way to put it. Comprehensive income has two main components: net income, the familiar bottom line profit,
Right.
and other comprehensive income, often just called OCI.
Okay, OCI. What kind of items typically fall into this OCI category?
OCI generally includes items like those unrealized gains or losses on available for sale securities we mentioned earlier.
The value change is not yet realized through sale.
Correct. Also, deferred gains or losses from hedging activities, those foreign currency translation adjustments for subsidiaries, and changes in the reported value of defined benefit pension plans. Think of OCI as capturing value changes that have occurred but haven't yet hit the main income statement through a realized transaction.
And how is this comprehensive income actually shown to investors? What does the statement look like?
There are two main ways companies can present it under JGAAP. The first is a single statement format.
Combining everything.
Yes, it combines the traditional income statement details with the OCI items, resulting in one continuous statement of profit or loss and other comprehensive income.
And the second way?
The second is a two-statement format. Here, the company first presents a separate traditional income statement ending with net income. Then it follows that with a separate statement of comprehensive income that starts with that net income figure and then adds or subtracts the OCI items to arrive at the total comprehensive income for the period.
Is one format more common?
Both are permitted. It's also worth noting that under current JGAAP, individual non-consolidated company financial statements aren't required to present comprehensive income. This is primarily a requirement for the consolidated group financials.
I see. Our sources mentioned an example from Fuji Electric using the two-statement format. Can you walk us through what that might look like?
Sure. In the Fuji Electric example, you'd see their regular income statement finishing with, say, net income attributable to owners of parent. Then, the separate statement of comprehensive income would begin with that same net income figure.
As the starting point.
Exactly. It would then list out the OCI items for the period. Things like valuation difference on available for sale securities, maybe positive or negative, and foreign currency translation adjustment.
Adding or subtracting these from net income.
Right. And then it shows a total comprehensive income figure. This total is then usually allocated between the amount attributable to the parent company's owners and the amount attributable to any non-controlling interest in subsidiaries.
Okay, that makes sense. Now, just like with per-share info, it seems the FSA also keeps an eye on comprehensive income reporting. Any common issues they flag?
Yes, a key area of focus for the FSA reviews has been reclassification adjustments.
Reclassification, what does that mean here?
These are amounts that were initially recognized in OCI in a previous period, but are now being reclassified or moved out of OCI and into net income in the current period.
Why would that happen?
Typically happens when the gain or loss is actually realized. For example, you had an unrealized gain on securities sitting in OCI. Now you've sold those securities. The gain is realized, so it moves from OCI into the regular net income calculation.
Ah, okay. So the FSA wants this movement shown clearly.
Precisely. They want to ensure companies are clearly disclosing these reclassification adjustments so that users can track how items flow between OCI and net income over time. They've noted instances where companies didn't properly label or disclose these movements, making it harder to understand the true components of net income.
So you need to see what part of net income maybe came from these older OCI items being realized now.
Exactly. Think of gains or losses realized on selling investments previously in OCI, or amounts from hedging activities, or foreign currency gains losses finally hitting the profit and loss. It's like moving money between different pockets. It was in the unrealized OCI pocket, now it's moved to the realized profit net income pocket.
Our materials even had a news article highlighting how OCI can be quite revealing.
Yes, that was a good example. It discussed how some major Japanese trading companies reported fantastic record net profits, largely due to high commodity prices.
Right.
However, these same companies also face significant losses related to their business interest in Russia following recent geopolitical events. Importantly, some of these losses, particularly those tied to equity investments, were initially reflected in other comprehensive income.
So they hit equity directly, reducing net assets, but didn't immediately hammer the reported net income figure.
That's the key takeaway. It demonstrates how comprehensive income can capture the financial impact of major events more quickly or fully than the traditional income statement might in the short term. And again, showing its importance, there have been past CPA exam questions specifically on comprehensive income.
Interesting. Any big differences between JGAAP and IFRS here?
Broadly, International Financial Reporting Standards, IFRS, tend to require a bit more detail and specific line items within the presentation of comprehensive income compared to JGAAP, but the core concepts are similar.
Okay, makes sense. Our final major area for this deep dive is retrospective adjustments, sometimes called prior period adjustments. This sounds like we're going back and changing the past.
In a way, yes. Retrospective application, restatement, and reclassification are all about adjusting financial statements that have already been issued for prior periods.
Why would you do that? Isn't consistency important?
Absolutely. Consistency is a fundamental principle in accounting. You want to be able to compare results year over year using the same methods. However, there are specific circumstances where changes are permitted or even required, and that necessitates adjusting the past numbers to maintain that comparability on the new basis.
Okay, so when would a company change its accounting policies, and how does that affect past statements?
There are two main scenarios. First, an accounting standard itself might change. In that case, the new standard often provides specific transitional rules on how to adopt it, sometimes retrospective, sometimes prospective, sometimes a mix.
And if the standard doesn't say?
If no specific transition rules are given, the general principle is to apply the new policy retrospectively, go back and adjust. The second scenario is when a company voluntarily changes an accounting policy for other legitimate reasons, maybe because a new method provides better information. In that case, retrospective application is also typically required.
And what does retrospective application actually involve doing?
It means the company has to go back and adjust the opening balances of equity, usually retained earnings, for the earliest comparative period presented in their current financial statements. They effectively recalculate past results as if the new policy had always been in place. They also have to restate the actual income statement and balance sheet numbers for all the prior periods shown for comparison.
Can you give us an example?
Sure. Let's imagine a company decides to change its inventory valuation method, maybe switching from FIFO, first in, first out, to the weighted average cost method, because they believe it better reflects their business. Under retrospective application, they'd need to recalculate their inventory costs and cost of goods sold for all the prior years presented in the reports, using the weighted average method. The cumulative effect of this change on profits from years before the earliest comparative period shown would be adjusted against the opening retained earnings of that earliest period.
And they have to explain all this.
Oh, absolutely. They need detailed disclosures in the notes to the financial statements explaining what changed, why it changed, and the impact of the change on key financial statement line items, and importantly, on earnings per share for all periods presented.
Seems like a lot of work. Are there ever situations where they don't have to do this retrospective adjustment?
Yes, there's an exception if retrospective application is deemed impracticable.
Impracticable. What does that mean in accounting terms?
It means it's essentially impossible or requires an unreasonable amount of effort or estimation. This might happen if the necessary historical data just doesn't exist anymore and can't be reasonably reconstructed. Or if applying the new policy requires making assumptions about what management intended way back then, which you can't objectively verify now. Or if you can't separate the information that was available back then from information that only became known later.
So only in very specific, difficult circumstances.
Correct. In those limited cases, the company applies the new accounting policy prospectively, meaning only from the current period forward or from the earliest date it is practical to apply it. They don't restate the past periods.
Okay. What about changes in just how things are presented on the statements, not the underlying accounting policy?
Changes in presentation methods, like, say, changing how operating expenses are classified or grouped on the income statement, also generally require restatement of the prior period financial statements. You want the comparison year to look the same format as the current year.
So you reclassify the old numbers to match the new format.
Exactly. And again, the company has to disclose the nature of the change, the reasons for it, and how it impacted the key items in those restated prior period statements. And similar impracticability exceptions exist as with policy changes, though perhaps less common for presentation changes.
Now, we also hear about changes in accounting estimates. How are those treated differently?
This is a key distinction. Changes in accounting estimates, like revising the estimated useful life of machinery or changing the percentage used to estimate bad debts, are applied prospectively.
Prospectively, meaning?
Meaning they only affect the current reporting period and future periods. You don't go back and restate prior periods.
Why the difference?
The rationale is that estimates are based on the best information available at the time they were made. A change in estimate isn't correcting a mistake. It reflects new information, new circumstances, or maybe just a better judgment based on more experience. So you reflect that new information going forward.
So it's crucial to distinguish an estimate change from correcting an error.
Absolutely. An error means something was wrong in the past. An estimate change means our view of the future has changed based on new data.
Our materials mentioned a tricky area. What if it's hard to tell if something is a policy change or an estimate change?
Yes, that can happen.
Mm.
In those ambiguous situations where it's genuinely difficult to distinguish, the accounting standards say you should treat it as a change in accounting estimate.
So apply it prospectively. Default to the simpler approach.
Essentially, yes. And interestingly, our materials specifically point out that under JGAAP, changes in depreciation methods, like switching from accelerated to straight-line depreciation for buildings or equipment, are treated as changes in accounting estimates.
Even though the method itself feels like a policy.
Right. This treatment aligns JGAAP with IFRS for consistency and practical reasons, even as conceptually you could argue it's a policy change. It avoids retrospective restatement for changes in depreciation method.
Okay, could you give us a quick recap with examples to help categorize these changes?
Sure. Let's see. Reclassifying, say, some admin costs as selling expenses on the income statement. That's a change in presentation restate prior periods.
Got it.
Switching depreciation methods, like we just said, or revising the estimated useful life of a patent. Both treated as changes in accounting estimates apply prospectively.
Okay.
But changing your inventory valuation method, say from average cost to FIFO, that's generally a change in accounting policy. Apply retrospectively, restate prior periods, unless impracticable.
That helps clarify the distinctions. Finally, let's talk about outright errors found in previously issued financial statements.
Right. Errors can happen, unfortunately. These could be mathematical mistakes, mistakes in collecting or processing data, simple oversights, or maybe misapplying an accounting policy or presentation rule, regardless of intent.
And if an error is discovered from a past period?
If a material error is discovered, meaning an error significant enough that it could potentially influence the decisions of someone relying on those statements, then the company is required to correct it by restating the prior period financial statements.
So similar to retrospective application for policy changes.
Exactly the same mechanics. You adjust the opening balances of equity for the earliest period presented and restate the amounts for all prior comparative periods shown, just as if the error had never been made.
And are there any impracticability exceptions for correcting errors?
No. This is a crucial difference. For correcting material errors, there are generally no exceptions for impracticability. If a material error is found, it must be corrected by restating the prior periods.
Wow, okay. So if a material error is found, it absolutely has to be fixed retroactively, no matter how difficult it might be to get the old data right.
That's the principle for material errors. Now, determining if an error is truly material often involves significant professional judgment, considering both quantitative size and qualitative factors.
And if it is material?
If a past error is determined to be material, it might even require the company to file amended financial reports with regulatory bodies like the FSA under the Financial Instruments and Exchange Act. It's a serious matter.
Understood. Any final thoughts on JGAAP versus IFRS in this area of adjustments?
Just briefly, besides the depreciation method point we mentioned, IFRS has a specific requirement that JGAAP doesn't explicitly mandate. If a retrospective adjustment, either policy change or error correction, has a material impact on the prior period information, IFRS requires presenting a third balance sheet, an opening balance sheet for the earliest comparative period presented. JGAAP doesn't have that specific requirement for an extra balance sheet.
Okay, interesting nuance there. Well, this has been an incredibly insightful deep dive into a vital, though maybe often less spotlighted, area of a company's financial reporting, the whole equity section, and these related adjustments.
Absolutely. And while the intricacies, the technical details of the equity section, comprehensive income, retrospective changes might seem quite complex.
They definitely can be.
They really provide a fundamental lens, a way to understand a company's underlying financial strength, its long-term stability, its resilience, and its overall performance. It offers a much richer perspective than just looking at the income statement in isolation.
So true. So as you, our listener, process all this information, we really encourage you to consider how these concepts, from the different pieces that make up retained earnings to what comprehensive income reveals, and the implications of accounting changes how all this contributes to a much deeper understanding of a company's financial story.
Yeah, it's about looking beyond the surface numbers And if this discussion has sparked further curiosity, maybe exploring specific line items within the equity section of companies you follow, or perhaps delving deeper into the nuances between JCAP and IFRS in these areas, could be really valuable next steps in your financial literacy journey.
Definitely. And on that note, considering the significant role that a company's equity plays reflecting its long-term value, its buffer against hard times, what key questions does this deep dive raise for you about the companies you follow, or maybe even about the broader landscape of financial reporting today? Something to think about.